1. Simple investing. Why not complexity? Clarity and transparency. Complex financial products often include jargon and hidden risks, making it difficult for investors to understand what they actually own. Simple strategies, e.g., index funds, basic asset allocation, are clearer and easier to follow, which increases investor confidence. This makes it possible to understand the core logic behind decisions. Conclusion: with simple strategies, investors know what they are doing, and this reduces the risk of poor decisions. 2. Simplicity from a behavioral finance perspective. Reducing emotional decisions. Complex strategies often trigger constant market timing, news monitoring, and position changes. This increases emotional reactions, fear and greed, and leads to costly mistakes. According to behavioral finance theory, simple strategies encourage more stable decision-making because they distance the investor from market noise. Consistent discipline. Simple plans make it easier to build long-term behavioral discipline. Instead of getting lost in complexity, the habit of following the plan becomes stronger. Conclusion: simple investing reduces psychological traps and improves decision consistency. 3. Cost and performance impact. Lower costs. Complex strategies often come with higher trading and management fees, which significantly reduce returns over time. Simple products such as index funds and ETFs generally have lower costs. Time and resource efficiency. Complex strategies require expertise, deep research, and continuous portfolio management. Simple strategies can be managed with far less time and resources. Conclusion: simple investing can provide lower costs and more consistent performance. 4. Historical and practical evidence. Simplicity for long-term success. Warren Buffett has repeatedly stated that most investors fall into the complexity trap, which often hurts performance. He recommends low-cost index investing and advises avoiding unnecessary complexity. Performance of simple strategies. Research shows that only a small percentage of complex strategies outperform simple ones over the long term. Conclusion: for most investors, simple strategies offer greater consistency and long-term success compared to complex approaches. 5. Simplicity and the learning curve. Improving financial literacy. Simple investment strategies make it easier for new investors to understand the market. Starting with fundamental principles rather than complex models leads to more durable knowledge over time. Conclusion: simple investing accelerates learning and enables more informed decision-making. 6. Advantages of simple investing. Clarity. Knowing what you're doing builds investor confidence. Emotional control. It becomes easier to stay calm during market volatility. Lower costs. Fees positively impact long-term returns when minimized. Consistent performance. Avoiding excessive trading and risk leads to more stable returns. Easier learning. Core financial principles become accessible to everyone. 7. Conclusion: simplicity is not a preference, it's a strategic advantage. Being simple in investing is not a lazy or careless approach. On the contrary, it is aligned with human psychology, designed to minimize behavioral traps, focused on reducing costs, structured to enhance long-term consistency. For individual and long-term investors, a simple investment strategy often delivers superior results compared to complex and aggressive tactics.